Okay, continuing our discussion of the balance sheet. So, balance sheet includes cash and equivalents um, versus other assets. So, all assets are stated in dollars, but this is important. Only cash and equivalents represent money that can be spent. Uh, there's a whole lot of assets on the balance sheet that property, plant, and equipment, and so forth that aren't easily converted to cash. So, this is uh, This is why we have ratios with regard um, to liquidity and so forth. Uh, Accounting alternatives, FIFO versus LIFO. So the hopefully you remember FIFO is first in first out versus LIFO last in first out. Yeah. So this refers to this inventory management, and so if um, a firm that uses it's very hard to compare a firm that uses FIFO versus one that is LIFO uses LIFO. Um, accelerated versus accelerated depreciation versus straight line depreciation. So a young firm um, with very low profits probably would want to use straight line, whereas a highly profitable firm would want to use accelerated. Accelerated moves that depreciation, that write-off, to earlier years and reduces taxes. Um, Common equity account is broken down between common stock at par, the and then paid-in capital, uh, and then retained earnings. So these two are combined if the common stock doesn't have a par value. So book value, they very rarely do they equal actual market values. The reason being is a firm is in business to generate profits. They're the and assets depreciate over time. So if the firm is successful, then it is very likely that the market value is going to be much greater than the book value of the firm. Time dimension. So, so when you receive those cash flows is important. So if a firm's not currently generating profits, that's going to reduce the value of that firm. So the time dimension with regard to the balance sheet. So the balance sheet is a single point in time, which as opposed to the income statement, which we go to next, which represent the the flows over a specific period of time, typically 1 year. So this is the balance sheet for our imaginary company that Unilite Textiles. So this is a December 31st balance sheet for 2016. In most cases, a balance sheet is going to show the prior year's results. So we've got cash and equivalents. So if we look at, for example, cash and equivalents drop from 40 to 40 million. These are millions of dollars, 40 million to 15 million. Accounts receivable went up from 160 to 180 million. Inventory increased. Total assets also increased. We go down here. So this would be traditionally, this is the left-hand side of the balance sheet and the right-hand side of the balance sheet. So this is what I was talking about. So assets has to equal liabilities plus equity. So total liabilities and equity is 145 million, whereas total assets are 845 million. So this is the makeup of this imaginary firm that we're going to evaluate. So the balance sheets also provide us with other information that we can calculate. Say for example, we can calculate the book value per share. If we know the number of shares outstanding, we take common equity and we divide it by the number of shares outstanding. Market value per share is simply just public information. Net working capital, current assets minus current liabilities. Net worth, total assets minus total liabilities. And of course, and this is our common equity. So just a reorganized version of the balance sheet equations, which was liabilities plus equity is equal to total assets. So breakdown of property, plant, and equipment. It was always referred to property, plant, and equipment was in the accounting classes. That's why I'll refer to it as that. So you have gross less accumulated depreciation. You have net property, plant, and equipment. So that depreciated value, and again, these book values are going to be less than the actual market value, assuming the firm is successful. So the income statement. We'll start the income statement in the next lecture.